look for 3 things in a business. It doesn't take long to understand a business, right? Look for 3 things. You want a business who you can see being around for the next 10 years. Longevity, right? You want a business that is producing cash flow, right? And then you also want a business that has a competitive edge. So let's break that down. What is a competitive edge? What does the business has over its competitors that says it can't go out of business, right? So let's think about this. This thing is called a moat that a business has. And let's think about a castle like in the old days, and it had this water around it to keep the invaders out, right? So I always want a business to have that. So one of the things that I love is a business that has lifetime customers. A business like Apple, right? So Apple has what's called this, it has 2 types of moats. It's a switching moat and a branding moat. Switching moat says that because I have this iPhone, what's the possibilities of me going to an Android? Slim to none. Why? Because everything I do probably is connected to the Apple cloud. So my phone is on it, my computer is on it, my laptop, everything I have. So for now, for me to go to another phone, I gotta take all of that off of there to go somewhere else. The chances of me doing that is slim to none.
Correct.
Right? Switching mode. How likely is it for a user to switch from this company to another company? That's important. Another thing is like a branding mode, right? So what is a branding mode? When you think about a name, this name sticks out. You think about this. When people think about a shirt with a collar, what do they call it? Polo, right? Branding mode. When a company name now becomes synonymous with an object.
Like Q-tip.
Q-tip. You think about cold drink, man, give me a Coke. You know what I'm saying? Branding modes, it's important, right? Another thing is market leadership. So when you think about a new industry, who's the head of that industry, right? Electric cars, you think Tesla. Out the gate, you think retail, you think Walmart, right? So it's not hard to get in it. The thing is getting you in and then just start understanding, yo, what does a good company look like? So I have these 5 rules I go by, and I call them rules, R-U-L-E-S. The R stands for reason. What is the reason that I'm at this company for? How did I get here? The U, do I understand it? Like, do I understand how this business actually makes money, right? That's important, right? Amazon, if I ask you, how does Amazon make money? You say, by shipping products out. And I'll say, well, that's the second way they make money. The first way they make money is Amazon Web Service. It's the biggest web service in the world, right? So you gotta understand that. Think about Disney. You say, how do they make money? Well, they entertain. Yep, they do. They also have streaming. They got ESPN. So you just you gotta the amusement parks. You gotta understand how they make money. It's important, right? So the R, the U, the L, the E is expansion. Can I see the business expanding without selling off assets, right? So you want a business to have to sell off assets to make money. So let's think about McDonald's, right? So McDonald's went from burgers and fries to 24 hours selling breakfast. It didn't cost them nothing. They added a drive-through. They just cut a hole in the window, got a drive-through, right? They didn't have to sell off anything to do that. So you want to see that. You don't want a business to sell off assets to make more money for us. So one of the things I love to do is, and this is where the patience comes in at, right? So one of the things I tell people is like, you got to understand the value of something before, you got to understand the value of the asset before you buy it, right? Like if you went and bought a car, if you bought the car at the sticker price, then you probably getting messed over. Right? If you bought a house at the market price, you probably getting messed over.
Retail.
Right? You don't want to do that. So one of the things I help people what I help people learn is how to actually find the value of what this asset is worth. Right? Like, I'm into this game. So think about this. So for Black Friday, people run to Walmart and all these places because they feel like these liabilities are on sale. Right? Well, when the stock market goes on sale, people want to take their money out. That's the perfect time to put money in. Right? Because in the streets, you make more money in a drought. And so I keep the same mentality when I'm investing. I teach all my people that, yo, like, while it's running up, what we need to be doing is researching businesses. We need to be researching them. We need to be finding out what they worth. Because what happens is, it's like expansion, right? You can only expand so much before it has to contract, right? You can only blow up so much before it has to come back. But when it comes back, that's when we unload. That's when we triple our net worth, yo. It's a game. So, and one of the things people always say is, why don't they teach us this in school? Right? So just let's think about this, right? Wealthy people don't make wealthy people rich. They give wealthy people ideas so that poor people can make them rich. So they can make us better consumers, right? So they can put something in our face to make us, right? So the lion is at the top of the food chain game. The lion will never tell the zebra, the giraffe, or the water buffalo how to get away. If he did, how would he eat? Right? Financial predators, financial prey. You gotta now transition to being a financial predator, right? And the transition is information. Like, this machine ain't going nowhere. You just gotta learn how to play it. And so it's, okay, when the stock market is going down, when they saying it's hyped up, like, I ain't tripping, I'm just, all right, cool. When it pulls back a little bit, 10% is a market correction. So if the stock falls back 10%, that could be a buying opportunity, right? But when the market started going down, like the last 2 weeks, I saw the market was down. I was like, oh, it's down. Let me go see what's going on right now. Let me see what deals I can find, because some things on sale. And everybody panicking. When I look on that TV and I see it's been red a week in a row, oh yeah, I get happy. All right, let me pay attention to my app now. Let me go in here and find some companies that I already got sitting on the side that I can buy. But if the stock market running, I don't want no part of that. Like, I'm making money. When you buy stock in the business, you are a part owner.
That's right.
At that point. Like, no BS.
Well, I own Disney then.
Yes, you are. Like,
Yes.
I teach my daughter that.
Yes.
No, I teach my daughter that. I was like, Stank, you own 250 shares of Disney. She was like, Daddy, I own Mickey Mouse. I said, you damn right. Yeah, when you own stock in the business, you actually are part owner. Like, you get voting rights. Like, they send you emails like, yo, this is what it's called in a proxy statement. Yo, this is what we're doing. This is what we lost money at. This is how we plan on making money. Oh, and by the way, we declaring a 50-cent dividend that's to you. As an owner of stock, you are now entitled to a portion of the profit that business makes. What makes you better is the more ownership you have, the more say-so you have.
Absolutely.
You feel what I'm saying? As with anything. Again, I'm not a financial advisor, y'all. Like, don't hold me to this. But the safest way to get in the game is by getting an ETF, right? Exchange traded fund. And so it moves like a stock, but it gives you a collection of stocks all at one time, right? So let's say you wanted to get it, you like bank stocks. You can get a XLF ETF, and now you own Chase Bank, Citibank, Bank of America. You own them all at once. It's a safe play. Like, let's say you wanted an ETF, you wanted to get into electric cars. You like trap, like, I like Tesla, but that is too high for me. All right, well, you can get an electric car ETF. So ETFs are great. You can just go to a simple website, etfdb.com, right? etfdb.com, and it'll have a bunch of ETFs on there. It'll break them down for you. You can't be scared to read. Like, you can't be scared to read. Like, I'm gonna just be real. Like, that's how you leverage the game, by reading. Most of us want to get rich fast, but we don't have the patience to build wealth, right? So I would say that the first thing you can get into is an ETF. Like, that's the safest play to get into. It's gonna mitigate the risk, and what I mean by that, it's gonna take some of the risk off. So what happens is, let's say I wanted to own Apple, but I'm not willing to take the risk. I might wake up in the morning, Apple down 8%. I might be like, yo, I'm about to sell, right? Well, you may own Apple. With this ETF, you'll own Apple, Amazon, Netflix. You'll own 10 companies. So if one company is down, the other 8 is finding the balance in it. If all 8 of them down, it still wouldn't be down as much as the one company would, because you found balance. So that's a great way to get in the game. And I want people to understand this too. Just because a stock goes down in price doesn't mean you lose money. You only lose money when you sell it when it's down, because you've locked the price, you've locked that loss in, right? So the stock goes down, if you bought more, you've now bought the price in which you bought it at, you bought it down. So if you bought it at $200 and the stock goes down to $150, if you buy more of it at $150, you've now bring it down to about $165. And so now you can make profit at $165 instead of waiting for it to get back to $200, right? So that would be the first thing I would do, is say, yo, just start with some ETF or some index funds, the S&P 500.
S&P 500. Right.
Yeah, so you can buy the VOO or the SPY. Great index funds. You own 500 businesses. You can't lose with that. On average, it gives you 8%.